Imagine waking up one morning, checking your phone, and seeing that money has been deposited into your account while you were sleeping. No boss, no client emails, no overtime shifts, no side hustle demanding your attention. Just cash flowing into your account because you own assets that pay you. For many Americans, that sounds like a dream. But for thousands of dividend investors across the United States, it's a reality. Today, we're going to break down exactly how you can build a $100,000 dividend portfolio that generates monthly passive income, the strategies wealthy investors use to create reliable cash flow, and the mistakes that can quietly destroy your returns before you even realize what's happening. By the end of this video, you'll understand how a six-figure dividend portfolio works, how much income it can realistically generate, and how to position yourself to create a steady stream of passive income that grows year after year. Let's start with a simple question. Why are so many investors obsessed with dividend income? The answer comes down to one thing: cash flow. Most people invest hoping their stocks will go up in value. That's certainly important, but appreciation alone doesn't put money into your pocket unless you sell your shares. Dividends are different. A dividend is a portion of a company's profits distributed directly to shareholders. When you own dividend-paying stocks, companies literally pay you for being an owner. Whether the market is soaring or falling, many established companies continue sending dividend payments to investors every quarter. Now imagine scaling that concept. Instead of owning a few shares, you build a portfolio worth $100,000. Suddenly, those small dividend payments become meaningful income. Depending on the average yield of your investments, a $100,000 portfolio could generate anywhere from $3,000 to $6,000 or even more annually. That translates into hundreds of dollars flowing into your account every month without actively working for it. While that amount may not replace a full-time salary, it can cover utilities, groceries, insurance premiums, car payments, or provide extra investment capital to accelerate your wealth-building journey. One of the biggest misconceptions about dividend investing is that it's only for retirees. In reality, some of the most successful dividend investors begin in their 20s and 30s. They understand something incredibly powerful. Dividend investing isn't just about the income you're receiving today. It's about creating a machine that becomes stronger over time. Every dividend payment can be reinvested into purchasing additional shares. Those additional shares generate more dividends. Those dividends buy even more shares. This creates a compounding effect that can dramatically increase wealth over decades. Think of it like planting a tree. The first year, the growth seems insignificant. The second year, not much changes. But after 10, 20, or 30 years, the tree becomes enormous. Dividend investing works the same way. The real magic doesn't happen overnight. It happens through consistency, patience, and reinvestment. Let's talk about the numbers because this is where things become exciting. Suppose you build a $100,000 portfolio with an average dividend yield of 4%. That portfolio would generate approximately $4,000 annually. Divide that by 12 months, and you're earning roughly $333 per month in passive income. Now imagine reinvesting every dollar of those dividends back into the portfolio. Over time, the income stream grows. As companies increase their dividends and your share count expands, your monthly income begins climbing higher and higher. Many investors make the mistake of chasing the highest dividend yield they can find. They see a stock offering an 11% or 12% yield and assume they've discovered a gold mine. Unfortunately, that's often where trouble begins. Extremely high yields can sometimes signal financial distress. A company may be struggling, its stock price may have collapsed, or the dividend may be unsustainable. Experienced dividend investors focus on quality first and yield second. Some of the most reliable dividend-paying companies have built reputations over decades. These businesses generate consistent revenue, maintain healthy balance sheets, and regularly reward shareholders. They often operate in industries people rely on every day, such as consumer goods, healthcare, utilities, telecommunications, and energy. These aren't necessarily the most exciting stocks in the market. They aren't usually making headlines for explosive growth, but they often provide the stability and predictability dividend investors value. Another critical concept is dividend growth. A company paying a 2.5% dividend today might seem less attractive than one paying 7%. However, if that 2.5% dividend grows by 10% annually while the 7% dividend remains stagnant or gets cut, the lower-yielding investment may produce significantly more income over the long term. This is why many successful investors pay close attention not only to current yield, but also to a company's history of increasing payouts. Now let's discuss diversification, because putting $100,000 into a single stock is incredibly risky. Imagine investing your entire portfolio in one company, only to watch management make poor decisions, profits decline, and the dividend get eliminated. Your income stream could disappear overnight. Diversification spreads risk across multiple companies and sectors. Instead of depending on one business, you're creating a network of income sources. If one company experiences difficulties, others can help stabilize your portfolio. Many investors choose a combination of individual dividend stocks and dividend-focused exchange-traded funds, commonly known as ETFs. ETFs can provide instant diversification because they hold dozens or even hundreds of companies. Rather than researching every stock individually, investors gain exposure to broad groups of dividend-paying businesses through a single investment vehicle. This approach can reduce risk while maintaining attractive income potential. Another fascinating strategy involves creating what investors call a dividend calendar. Most American companies pay dividends quarterly, but they don't all pay during the same months. Some pay in January, April, July, and October. Others pay in February, May, August, and November. Still others pay in March, June, September, and December. By strategically selecting investments with different payment schedules, investors can create cash flow that arrives nearly every month of the year. This is where the idea of monthly passive income becomes especially appealing. Even though many companies distribute dividends quarterly, careful portfolio construction can result in payments arriving throughout the calendar year. There are also certain investments specifically designed to distribute income monthly, which can further smooth out cash flow and make budgeting easier. Let's address a question many viewers are probably asking right now. How do you actually build a $100,000 portfolio if you don't already have $100,000? The answer is surprisingly simple, though not necessarily easy. It starts with consistent investing. Many Americans underestimate the power of regular contributions. Investing a few $100s every month may not seem life-changing today, but over years and decades, those contributions can accumulate into substantial wealth. Consider someone investing $500 per month while earning an average annual return. Combined with dividend reinvestment and market growth, that portfolio can grow significantly over time. The key is consistency. Wealth creation rarely happens through one spectacular investment. More often, it results from disciplined behavior repeated over many years. This principle becomes even more powerful when utilizing tax-advantaged accounts. Americans have access to tools like 401(k)s, traditional IRAs, and Roth IRAs. These accounts can help investors reduce taxes or allow investments to grow tax-free under certain circumstances. Since taxes can significantly impact long-term returns, understanding account structures is essential for maximizing dividend income. Speaking of taxes, let's talk about something many new investors overlook. Dividend income is not always tax-free. Depending on the type of dividend and the account where it's held, investors may owe federal taxes and potentially state taxes. Qualified dividends often receive favorable tax treatment compared to ordinary income, but tax rules can change, and individual situations vary. This is why many investors strategically place dividend-producing assets in retirement accounts to improve tax efficiency. One of the most powerful psychological benefits of dividend investing is that it changes the way you view market volatility. When stock prices decline, many investors panic. They watch their account balances drop and assume something has gone terribly wrong. Dividend investors often view downturns differently. If the underlying companies remain financially healthy and continue paying dividends, lower prices can actually create opportunities to buy more shares at attractive valuations. Imagine walking into your favorite store and discovering everything is on sale. Most people would be thrilled. Yet when stock prices fall, investors often become fearful. Experienced dividend investors understand that lower prices can increase future income potential because each dollar invested purchases more shares. More shares mean more dividends. More dividends mean more income and greater compounding. Of course, dividend investing isn't completely risk-free. Companies can reduce or eliminate dividends. Economic recessions can pressure corporate profits. Interest rate changes can affect investor behavior. Inflation can reduce purchasing power. These risks are real and should never be ignored. However, careful research, diversification, and long-term thinking can help manage many of these challenges. Another important factor is inflation. Let's say your portfolio generates $4,000 annually today. If inflation averages several percent per year, that income may buy less in the future. This is why dividend growth is so important. Investors want income streams that increase over time rather than remain stagnant. Companies capable of regularly raising dividends can help preserve purchasing power and support long-term financial goals. One reason dividend investing remains popular among financially successful Americans is that it aligns with a fundamental principle of wealth building: owning productive assets. Wealthy individuals often focus on acquiring assets that generate income rather than liabilities that consume it. Dividend-paying stocks represent ownership in real businesses producing products and services used by millions of people every day. As those businesses grow and prosper, shareholders can benefit through both rising stock prices and increasing dividend payments. Let's imagine two individuals. The first spends every dollar earned and relies entirely on employment income. The second consistently invests in dividend-producing assets. 10 years later, the first person may still need to work for every dollar earned. The second person may have developed a growing income stream independent of active labor. That's the transformative power of investing. It allows your money to begin working alongside you and eventually, in some cases, for you. The journey toward a $100,000 dividend portfolio requires patience. It requires discipline during market declines. It requires resisting emotional decisions driven by fear and greed. Yet the reward can be extraordinary. Every dividend payment serves as evidence that your assets are producing income. Every reinvested dividend strengthens the portfolio. Every contribution moves you closer to greater financial independence. So if building a $100,000 dividend portfolio sounds ambitious, remember that every great portfolio starts with a first investment. Every six-figure account began with a single contribution. The sooner you begin, the more time your money has to compound, grow, and generate income. Years from now, you may look back at the moment you decided to start and realize it was one of the most important financial decisions you ever made. The path to monthly passive income is not a shortcut. It's a journey. But for those willing to stay the course, it can become one of the most rewarding wealth-building strategies available.